Hello, this is Fred Atwater here. It's a little NXS called Mystify. And I'm going to demystify probably the most important topic that I see misconstrued in the options market. Let's do it. You ready? Let's do it. All right. A little bit of those guys right there. This particular topic is so important. I made a slide. Look at this. This is like out of the advanced trading book that doesn't exist, that maybe I'll write. And we're going to call this advanced trading first class. This is not beginner class where you learned what a call and a put is, or what a short call and a short put is. This is very particular to the exploitation of the characteristics of those options. All right? And I've been told a number of times in the hundreds and over the years that I'm very good at explaining things, and I appreciate that. I just have a methodology of processing things, putting them in my CPU, my brain space, and then broadcasting them back out in a manner that folks can understand. And I appreciate that capability, that talent and practice. It hasn't come without mistakes, and it hasn't come without learning constantly about the market. So, Options Advanced Trading 101. I want you to understand this. This is contract specifications versus contract performance. All right, I dated it today. That's how important this is, guys. It was so important, I made a slide, and this is a class. All right, if you want to do this, this is also on a real-time example. I have Netflix pulled up on the slide behind us. All right, we are in this trade. We entered on yesterday's green candle. We had a bit of an upside, I don't know, a favor to the high side doji there, maybe even a hammer. It's not quite a hammer to me, but what I really like, and actually credit to Jeremy Newsom for teaching me this shape. He uses it on 5-minute charts and on a lot of other narrower time frames. And if you understand the market's by its very definition is fractal. The presentations and times are fractal, which means the patterns present themselves in all time frames. But this happens to be a daily chart, so on a daily chart we can expect daily or days till we get results, versus a 5-minute chart you might expect a series of 5 minutes to pass, maybe 60 minutes total or 30 minutes total before you get results. Or on a tick chart you might expect, on a 333 tick chart, you might multiply that times 10, and after 3,000 transactions, you might start to see something develop. Here's what I learned from Mr. Newsom. This should be familiar to the real life trading team. Is the common shape that's right here. This, I've come to call it the bullish S. Okay, bullishness, if you want to call it that, because it has a characteristic of doing that, and it's sort of the backwards S. The same is true when you flip around and do a bear curve, and Jeremy often exploits that on a gap, his gap techniques there. But the same shape applies, and then if you also pull up a, already got it loaded, you pull up a percent tool here, and it is just magic. Boom, it's right there. Look at that retraction. That stick goes right to the 50% level. And it's just absolute pure Dow theory in action. It's an awesome shape. Know it, love it, memorize it, because it works. Let's remove the drawing. This class is not necessarily about how to recognize shapes in here. This is about contract specifications versus contract performance. All right, let's go over here, and I already pulled this up. This is called the call. This is a basic call. So for the basic options traders, a call is everybody seems to know the definition of a call. It's call options are contract option that gives the buyer the right, not the obligation, to buy a stock, bond, or other instrument as a specified price, which is also known as the strike price, by a specified time period. The underlying commodity is also called the underlier or the underlying instrument. So when we scroll down here, they translate some terms, and this is where the options, the person that basically understands options, took, undergrad level options, they know a single call option contract can give the holder the right to buy 100 shares. Okay? And that's what they know. They treat it as gospel. However, if I were to buy 100 shares of Netflix, as you know, Netflix closed at $413.50, so 100 shares would cost me $41,350. I can get long, and I'm not going to say long 100 shares because that's incorrect. I can get long the right to buy 100 shares at a given strike price for, let's look at the trade tab here. So this is a front month here. This is next month, 17 August. And if you wanted to use an example here, you wanted to say I wanted to get long the, I don't know, let's call it the 400. I want to use the 400 strike to get long. I'm not recommending that. I would not do that, but I would be long. I would just be long in a different manner. You are going to buy the right, those call contracts for whatever the mark is here at 400. It's about 32 and a half. Let me see. Get my mug shot out of the way. Oh, sorry, the mark on the red column here. So the 400, yeah, roughly, what did I say, 32 and a half? It looks like 32 and 5/8 right there. So versus the 41,350, every undergraduate, understander or of a call option says, oh, well, why don't I just get long for $3,200 instead of 413 or 41,000? And they're like, oh my gosh, that's a great deal. In my professional side, advanced options trading, it may or may not be such a good deal, all right, because of this right here. Options contract specifications versus options contract performance. And what do I mean? Guys know, I hope the advanced options trader that are watching this can know that I'm about to point out the most important column on this chart. There's two most important columns. One is slightly more important than the other, and that's this column right here. Okay, so the options contract at 400 says I have the right to buy. I'm buying the right to buy 100 shares of Netflix. That right to buy is costing me $3,267, $3,267.50 right there. I don't think anybody disagrees with that. However, that's the contract specification. Okay, this is the contract. It's part of the formula that makes up the contract performance, which is down here at 60. This number 6165. It's a 0.6165 multiplied times 100. It's a 61.65. That means you can look up delta too. Like, so a beginner or a sort of an amateur novice broad market trader will understand that delta means the performance of that option. But to put it into realistic terms, I didn't. And what I see very often is people think that they bought that option, and it's going to perform just like 100 shares of Netflix. That's not true. It's going to perform at the delta depreciated by the theta drag that's on that option. So this 400 strike call, if I buy that, I'm only going to get 61.65% dollar for dollar at this moment in time on the performance side. So if Netflix goes up $10, and linear math, I know that things change in the options market. Linear math goes up $10. I'm going to make, if I had 100 shares, I would make $100 on Netflix. All right, if it goes up. Sorry, if it goes up. If Netflix goes up 10 shares on or $10 on $100, I'm going to make $1,000. 10 times 100. The quick and dirty and easy math on this, and it's a broad brush because delta changes as the underlier changes. I would make about 61%. I'd make a little more. I'd probably call it about 64% of $1,000. I'd make $640. Or if I just didn't even touch that number, I'd make $616.50. That's the performance difference of that. Now, here's what I see most options traders doing. I've seen it so many hundreds of times. They actually buy this at the money, and they'll bump up into the black here, and they'll buy this one. Happens over and over and over and over. I mean, so much. I've seen it so many times. They'll buy this 415 right here, expecting the same math that I just did. Oh man, Netflix went up $10. All right. Well, how come they didn't make $1,000 on that contract? Because the contract specification was for 100 shares, but the contract performance is a delta number, drugged down by theta and sort of influenced by gamma and implied volatility. So if I leave out the theta, leave out the gamma, leave out the IV, a $10 increase in Netflix would cause a $1,000 if you had the shares, but it would only cause 52% gain of that $1,000, or $520. In this case, $523.40. All right. Over time, this contract specifications suggest, not just suggest, demonstrate they're going to be drugged down by the rate of $35 per day. That is your penalty tax for not understanding how options work. All right, $35 a day is the penalty tax, unless you know what you're doing and you flip the equation over and you sell theta, you're short theta, and then that short theta, that tax gets paid to me because I sell that theta. I'm trying not to lose folks on this. This is a very complex topic. So let's look at this other thing called this thing called theta that we're still talking about. And there's this phrase that I use, and I was taught. I'm gonna type it out here real quick so that it's here. Theta is greater ATM. Okay, we're gonna put that over here because this is very, very, very important to know, love, breathe, understand. Theta is greater at the money, and this applies to every single options contract board on the entire planet, in the whole SIBO world. All right, so theta, notice it's a negative number on the call side. It's actually a negative number over on the put side too. This means the rate of decay of that option. And so this phrase over here, theta is greater at the money. Remember I said most traders are going to go out here and see this 415 and be like, ooh, I'm making such a wise, smart choice. Maybe If the underlier zips up in a day or 2 or 3, okay, they're going to pay a little bit of penalty tax and then they're going to get out. Okay, but if you hold this thing for a month, you're just going to get absolutely slaughtered on theta decay. Theta is greater at the money. So the at the money line is this line right here. Okay, we got a negative 35.45 here and a negative 35.40. So it looks like this one is the closest at the money, within a few pennies there. Let's look at that again. So we'll call this one the ATM one. ATM is actually right in between those two, but negative 35.45. Theta is greater at the money. If I go this way down in strikes, in the money, this way is in the money. Yes, in the money. I got my call strike set up, and this way is out of the money. Either way that I go from this, the number gets less and less and less and less. If I go this way, that number gets less and less and less. Do you guys follow that? That's very important to understand. The further away from at the money I go in either direction, the less my theta decay is, because every single chart out there, theta is greater at the money. So that's another performance characteristic versus a contract specification of the option. Let's go out here in time a little bit, and let's go out to the let's close down this 17 August. I don't know, let's go out here to Jan 19. All right, it's a little over a year away. Same strike price. Actually, 415's right here. There is no 415 strike for sale, but if there were, it'd be right in this range. It'd be a negative 13. The other one was a negative 35 something. There's roughly 1/3, a little tiny bit less than 1/3 the theta decay way out in the future. Okay, and then if we go way out another year, which is Fred style, very common, let's do that. That one's a negative 13. Let's go out here to the 17 Jan 20s, which everybody's like, well, why does Fred go so far out in the future? You could just buy these other ones. Well, when you buy 5, 10 contracts, or people that train me how to do this 100 contracts at a time, look at my theta number. All right, the 415 is not displayed on this one again, but I'm down to a negative 0.08. And look, if I walk up the ladder, theta gets less and less as I get away from at the money. I could do that on 1 million charts, and 1 million charts would show the exact same characteristic. All right, why? Because theta is greater at the money. All right, now let's talk about philosophy on using 0.7 to 0.8 delta, because it's a performance characteristic that we're looking for. This is 0.7 to 0.8. I was trying to draw a D right there. 0.7 delta to 0.8 delta. So this is easy, and I almost always go, over time I've learned to go almost always for that line right there, that 75 deltas right there. I can very easily predict my movement, my contract performance, right? I know what the contract specifications are, but I can very easily determine this right here, because I've minimized my theta decay and I've become predictable on my delta, and my gamma is actually pretty low. I don't even have that column displayed here. So when I'm way out here, a little bit in the money, gamma is like 3%, 5%, something like that. It's a pretty low number. and implied volatilities get muted way out in the future. So I can become very predictable on contract performance. So if I buy the 0.75 D leaps on Netflix, I can calculate I can't even type. Calculate 75 deltas per dollar of underlier movement. All right. With a high degree of accuracy. You tell me, anyone, and because I can't do it, I can't go back into the front month and buy that at the money and set on a chart where that thing is going to move without some amount of unreliability, like 30% accuracy, this big wage gauge in there, because implied volatility just ruins my calculations. Well, I mute it out when I go way out in the future. I mute out the theta decay, and I just focus on the delta capability of this option. So when people say, well, why do you go so far out in that 0.7 range, 0.8 range? Because I can compute the movement of the option very accurately. It's 75% at the 75 delta level. So if I becomes, so if I want to make $750 on a leap position, okay, that would mean I need the underlier to move $10. I mean, it's that easy. So when I went back to that opening statement of saying Netflix, what if Netflix went up $10? I can calculate I'm going to make about $750 very, 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 very accurately with this technique. All right, and I'm not going to pay a penalty tax of theta decay, $35 a day back on the front month. I'm not going to pay that because I'm just going to pay a more like a normal specification tax here of $8 a day. All right, and I'm going to mute out gamma and mute out implied volatility because I'm way out here in the future. All right, so that is an in-depth discussion of why I do things the way that I do. It's because I understand the board. All right, and it's not because I sat down. Well, I have sat down for a number of tens of thousands of hours and studied this, but I was trained. You understand? I mean, I was trained to do this. There is proper's not the correct word because you can buy whatever you want. It's your money. There is a successful way to do it, though. Okay, and it's buy delta, sell theta. I've said that many, 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 many times. You buy the delta, you go way out in the future, and then you come back to the front month and you sell the theta. All right. Whew, that was long, and I hope you stuck with me because I am trying to demystify the options board to people. And this brief was about options contract specifications versus options contract performance. I may have opened up a giant can of worms, and it might get harder to explain to folks, but it's very clear in my mind, my head. So ask away while this is still free, because this is free. I can use videos on YouTube. I can use other things. I don't charge money, but the second I go into the for-fee services and collection and commercial entity of how to trade, I can't use some of these cool little resources without violating some kind of trademark or copyright or something like that. But for the moment, it's free. Ask away, because I got a couple other back side offers. I got a big one a week ago, and then I have another one on present. It's really cool to be offered these things. Let's demystify options trading to the max extent. All right, thank you. All right. 3, 2, 1.